Good evening, all of you, dear students. Yes, in the previous session, we have completed the introduction part of our subject financial management, right? Now, in today's session, first, we need to go for the index, the areas to be covered. Let me write the index. You can see it on the screen, right? First one, time value of money. Second one, investment decisions, capital budgeting. Cost of capital, capital structure, leverages, working capital management, ratio analysis. Along with this, we should cover dividend policy, risk analysis in capital budgeting, risk analysis in capital budgeting. And the next area is theory. These are the areas we need to cover, okay? Along with this topic, capital budgeting, we should also cover another area called advanced concepts in capital budgeting, which is also the topic called capital budgeting. But we should understand some of the advanced concepts in capital budgeting. Related to that, we need to solve few sums also, okay? This is a sub area of investment decisions actually. Okay, these are the areas we need to cover. The last areas are dividend policy, risk analysis in capital budgeting, and theory, right? Yes. Please write this index. Yes. Yes. Let me start with the first topic, time value of money, which is the heart of the subject financial management. Every topic is highly dependent on time value of money, which is the base. Okay. The entire stock market is purely dependent on time value of money. This is very important topic. Without using this topic, we cannot understand the remaining topics. The stock market related valuations and asset valuations, business valuations, all the areas are completely dependent on the area called time value of money. This is an important topic, remember that. Yes, please look at the name of the topic, time value of money, right? It is simple. Value of money changes with time. Simply, what is the meaning of time value of money? The value of the money changes with time. It changes from one point of time to another point of time. So we are talking about value of money at different points of time. Is it clear? When I say money, it includes so many areas. It includes money. Of course, it includes money. And it includes money equivalents also, cash equivalents. Money equivalents means assets. It includes business, because business means group of assets. And it includes financial assets. What was that? Financial assets. That means when I'm talking about value of money, it is not only money, it is related to money related components called assets, business, and financial assets also. And I'm going to calculate this value of money at different points of time. Yes. First of all, value of money means I'm going to calculate value of money, value of assets, value of business, value of financial assets like value of equity shares, value of preference shares, value of debentures, and value of bonds. This topic deals with every area. Are you getting my point? At different points of time. Different points of time means what? You know, the points of time can be classified into three parts. One is present, other one is future, right? Present, future, and you know that past. So I need to calculate future value of money, present value of money, past value of money, generally, right or wrong. But I'm not going to deal with this area called past value of money. I'll deal with only two areas. One is present value of money. The other area is future value of money. Are you getting? So in this topic, time value of money, we need to handle the areas called present value and future value. Present value of money and future value of money. Future value of money. That's what we need to deal with. Okay. Yes. Before going to the topic, so we understood that that particular value of money changes from one point of time to another point of time. So I can say present value and future value both are different. Yes. Let me ask you one question. It's a regular question. Again, I'm asking you. If I'm offering 1 lakh rupees today or 1 lakh rupees after 1 year, which one you will prefer? I'm asking you people. Is it today's 1 lakh rupees or after 1 year 1 lakh rupees? I'm asking you. Today's 1 lakh rupees only, right or wrong? Oh yeah, yes, definitely you'll prefer today's money and you'll reject the future money. You don't prefer after 1 year money, you'll prefer today's money only. You'll prefer 1 lakh rupees today only. I need reasons why you are preferring today's money rather than future money. Why you are preferring today's money rather than future money? Yes. New students should answer for this question, okay? Just think about it. Yes. Why you are preferring today's money rather than future money? Why only today? Why not future? Why today's money only? Why not future? Yes, please. Means? I'm not getting you. Yes. Okay. Are you talking about interest or you're talking about the value of money? You're talking about interest. That means you can earn some interest by investing this money today, right or wrong? If I give you 1 lakh rupees today, immediately you can deposit that money in a bank and you can earn some amount of interest, right or wrong? During this 1 year period, you can earn some amount of interest. If you are a businessman, you can invest this 1 lakh rupees in your business and you can earn some amount of profit. That is what? Opportunity cost. You can say it. Opportunity cost. Kuchovaya. Opportunity cost. Opportunity cost, right? The first reason is opportunity cost. You know, opportunity cost is the first reason why you are preferring today's money rather than future money? Why you are preferring today's money rather than future money? Because you can invest 1 lakh rupees today and you can earn some amount of interest from the banks or from the companies, or you can earn some amount of profit by investing the money in your business. So you don't want to lose that particular opportunity benefit. So because of that reason, you will prefer today's 1 lakh rupees but not future 1 lakh rupees, right or wrong? This is one of the reasons why you are preferring today's money rather than future money. Yes. One more reason I'm expecting from you people. The second reason. Why today, why not future? You're talking about risk. May I know what is the meaning of risk? Yes. He is saying the future is uncertain. The future is uncertain. You may receive it or not. You may get it or not. The future is uncertain. So when the future is uncertain, you don't prefer future money. You'll prefer today's money only. A bird in hand is much better than two in the bush. Right or wrong? You'll prefer today's 1 lakh rupees but not future 1 lakh rupees, because the future 1 lakh rupees is uncertain. You don't want to take it. Right or wrong? So the second reason is risk. The future involves risk. Since the future involves risk, you don't prefer future money. You'll prefer today's money only. This is the second reason. Can I expect one more reason? The third reason is, two reasons were completed. The third reason is inflation. Sir, what is the meaning of inflation? The purchasing power of money. See, by using this 1 lakh rupees, you can buy some required articles today. The same articles you may not buy by using the same money after 1 year, right or wrong? So because of that reason, I'll prefer today's money rather than future money. The purchasing power of 1 lakh rupees may decrease after 1 year, right? Because of inflation. So inflation is the third reason why you are preferring today's money rather than future money. So this is one more reason. I'm expecting one more reason from you people. Yeah, it's a regular reason. Preference for present consumption. If I give you 1 lakh rupees today, by using such 1 lakh rupees, you can buy your required articles. You can buy your required things. You can consume it immediately, right? You'll prefer today's consumption rather than future consumption. What do you say? You can buy an iPhone, or you can buy a bike. You can go for any article. You can buy it and you can use it. You can satisfy it. The utility comes immediately, right? Generally, people will prefer immediate utility rather than future utility. What do you say? So, people prefer present consumption rather than future consumption. This is also one of the regular reasons why everybody will prefer today's money rather than future money. So, these are all the reasons why we are preferring present money rather than future money. So, what are the 4 reasons? Please tell me. Opportunity cost, risk, inflation, preference for present consumption. If you ask me, the most important reasons why you are preferring today's money rather than future money is risk and inflation. These are the 2 important factors, predominant factors. These are the 2 important factors why everybody will prefer today's money but not future money. If you prefer 1 year, the 1 lakh rupees after 1 year, that means you have to face 2 types of risks. One is inflation risk, and the second one is regular risk. Risk of receiving the money, right or wrong? You may get it or you may not get it. The person who is offering 1 lakh rupees may die or you may die, right or wrong? The future is always uncertain. So, inflation risk and general risk, these are the 2 reasons why everybody will prefer today's money rather than future money. If you are ready to accept future money instead of today's money, that means you are ready to accept these 2 risks, right or wrong? the risk of receiving the money, future money, as well as inflation. That means you're sacrificing what? You're sacrificing today's money and you're ready to get the future money. When you're ready to get the future money, that means you're going to face future risk. You're going to face future risk as well as you're going to face future inflation. So to compensate these two factors, generally investors will expect interest. Generally investors will expect what? Interest. Interest is a compensation for what? Risk and inflation. Why every bank is offering interest to you? Why every bank is offering interest to you? Because the bank is retaining the money of you, right or wrong? It is retaining the money which belongs to investors. And investors are ready to receive their money in the future. That means they are ready to accept risk. That means they are going to face inflation. To compensate those two factors, every bank is offering what? Interest to the investors. Every financial institution is offering interest to the investors. Every company is offering what? Interest, preference dividend, and equity dividend to the investors, right or wrong? Based on the nature of the investment. See, in addition to the principal which you have invested, the company is going to give you interest if you are a debenture holder. It is going to give you preference dividend if you are a preference shareholder, and it is going to give you equity dividend if you are an equity shareholder, right? Why it is giving in addition to the principal? Because you're waiting. And the company is retaining your money in the company, right or wrong? So that means you're ready to accept risk and you're going to face what? Inflation. Because of this reason only every bank in the world is offering what? Interest. Are you getting? Yes, this is one of the important factor for what? Time value of money. So now you can say, can I say like this? The worth of a rupee received today is equal to the worth of a rupee to be received in future? No. Then what could be the conclusion? The worth of a rupee received today is different from the worth of a rupee to be received in future. This is the basic definition of the term time value of money. Okay. What is that? The worth of a rupee received today is different from the worth of a rupee to be received in future. This is the definition of time value of money generally. Okay. Yes, in this particular topic, time value of money, we need to cover these areas. I mean, these are the learning objectives, the areas to be covered. What are the areas we need to cover? The first area is compound interest. And future value. What is the first area? Yes. The second area is present value. Present value. Third area, annuity concept. Future value of annuity. Future value of annuity. Present value of annuity. Third and fourth concepts are related to annuity, future value of annuity, and present value of annuity. Next area, present value of perpetuity. What is the next area? Present value of perpetuity. Next area, present value of growing perpetuity. Present value of growing perpetuity. growing perpetuity, and the final area is effective rate of interest. So these are the areas we need to cover in this topic, time value of money. What are the areas? Please read it. Compound interest and future value, present value, future value of annuity, present value of annuity, present value of perpetuity, present value of growing perpetuity, effective rate of interest. One more area, simple interest. It is not at all important, but I'll deal with it. Okay. I'll tell you the formula only. What was that? Simple interest. Yes. Yes. Okay. Let me start with the first area. Compound interest and future value. Listen. For example, if you are investing 1000 rupees today at an interest rate of 10% for first year, after 1 year, it becomes how much? Please add interest to 1000 rupees. 1000 rupees plus 1000 into 10%. Am I right? It will be 1100, right? 1100. And after 2 years, again calculate 10% interest. Listen. Please don't apply 10% on 1000. Why? Because I should calculate interest on 1100. Because the interest for first year becomes the principal for second year. That is what compounding concept. For every period, we'll calculate interest on interest. Am I right or wrong? We'll calculate interest on interest. Here we are going to calculate 10% interest on 1100 rupees, which includes 1000 rupees principal plus interest for first year, right or wrong? That's why this is called interest on interest, compounding. So please apply 10% interest on 1100, but not on 1000. I'll get. Yes, it will be 1100 plus 1100 plus 1100 into 10%. I'll get 1210. Am I right? Can you calculate after 3 years also? Yes, you can. After 3 years, 1210 plus 1210 into 10%. We'll get 1331. Like that, you can calculate interest for n number of years, right? You can calculate interest for n number of years on compounding basis. For n number of years, you can do this, right or wrong? Now, the amount which is invested today, represents year 0 investment. This is year 0. What is this? Year 0. This is your year 0 investment, which is known as present value. Which is known as what? Present value. The amount of 1000 rupees which is invested today is known as present value. Yes. And this 1100 rupees after 1 year represents future value at the end of first year. At the end of first year. And this is future value at the end of second year. 1210 represents future value after second year. And this is third year future value, right? Like that, I can calculate future value at the end of nth year also. Am I right? Hello. Like that, I can calculate future value at the end of nth year also. Now, you can observe some pattern here. Please take the common term 1000. I'll get 1000 into 1 plus 10% whole to the power of 1. Am I right? Whole to the power of 1. So if I want to calculate future value at the end of first year, I should simply multiply 1000 rupees with 1 plus 10% whole to the power of 1. Yes. Now observe second year value. Take the common term 1100. Then I'll get 1 plus 10% whole to the power of 1, of course. And in the place of 1100, I can write 1000 into 1 plus 10% into 1 plus 10%. Then I'll get 1 plus 10% whole to the power of 2, right? Whole square, right? Are you getting? So if you want to calculate future value at the end of second year, then such 1000 rupees must be multiplied with 1 plus 10% whole to the power of 2. The same is the logic applicable for third year also. It will be 1000 rupees into 1 plus 10% whole to the power of 3. If you can simplify this expression, you'll get this term 1000 into 1 plus 10% whole to the power of 3. Are you accepting it? Like that, you can calculate your future value for n number of years. 1000 into 1 plus 10% whole to the power of n. So whole to the power of n, that means nth year ending 1000 value at 10% rate of interest, right? So for first year, it will be 1000 rupees into 1 plus 10% whole to the power of 1. For second year, 1 plus 10% whole to the power of 2. Third year, 1 plus 10% whole to the power of 3. And for nth year, it will be 1 plus 10% whole to the power of n. Are you getting? Like that, for n number of years and for any rate of interest, I can convert any present value into future value with the help of a simplified mathematical formula called future value is equal to this 1000 rupees is present value, right? And this 10% is R, and this 1 is number of years or number of periods. Okay, so the formula will be future value is equal to present value into 1 plus R whole to the power of n. This is a formula for future value. What is the formula? Present value into 1 plus R whole to the power of n. Or it can be rewritten as present value into this 1 plus R whole to the power of n is technically known as future value factor, FVF. What was that? Future value factor. What was that? Future value factor. My dear students, future value factor means it is nothing but 1 plus R whole to the power of n. Which means we have a table called future value factor table. There you can refer your factors at any rate of interest and for any number of periods generally. For a defined period, there will be a table. We have a table called what? Future value factor table. I can refer it. Okay. So for the purpose of calculating future values. So the formula will be present value into future value factor R comma n. What is the formula? Present value into future value factor R comma n. If I say future value factor, the formula for future value factor will be what? 1 plus R whole to the power of n. Are you getting? Yes. You know, this can be rewritten as future value means amount of future value A into present value means principal into 1 plus R whole to the power of n. Regular formula only, okay. My question is, future value and present value both are same. Am I right or wrong? I'm asking you. Future value and present value both are same. Am I right or wrong? No. Yes, definitely no. This is present value 1000 rupees and this is future value 1100 rupees. What is the difference? The difference is what? Interest. The difference is interest. This is principal. This is 1100 is principal plus interest. 1100 is present value plus interest. So can I say like this? Present value means principal, investment, Present value means principal, investment. Future value means principal plus principal plus interest or investment plus interest. Am I right or wrong? Your future value will be loaded with two components. Your future value will be loaded with how many components? Two. One is my principal, present value. Other one is my interest. In our context, we are discussing about interest. If it is a business, your future value will be loaded with two components. One is my investment, the other one is my profit. What do you say? The second component is my profit. Your future values in the business will be loaded with two components. One is my investment component, the principal investment which is invested in the business in year 0. And the second one is the profit which I am expecting. Am I right or wrong? So your future value will be loaded with two components. One is principal, other one is interest. If I am asking about business, it will be one is my investment, the second one is my profit. Are you getting? Yes. So now we are talking about interest only. So my future value will be loaded with two components. One is principal, other one is interest. If I remove principal from the future value, then I'll get what? Interest. And we are calculating interest on which basis? Compounding. So I'll get compound interest if I remove what? Principal from future value. So the formula will be compound interest CI is equal to P into 1 plus R whole to the power of N represents what? Future value. P into 1 plus R whole to the power of N represents what? Future value. If I remove principal from here, I'll get what? Compound interest. Are you getting? By deducting principal from future value, what you will get? Compound interest only. So take the common term P. So the formula will be 1 plus R whole to the power of N minus 1. This is the formula for what? Compound interest. That's it. Are you getting? Yes. Where R is equal to interest rate per period. Where R is equal to interest rate per period. N is equal to number of periods. N is equal to what? Number of periods. FV is equal to future value. PV is equal to present value. PV is equal to what? Present value. I'll tell you one thing. My future value is equal to present value if there is no component called 1 plus R whole to the power of N. What do you say? If you remove this component, then my future value is equal to present value, right? If you multiply this component called future value factor, then I'll get future value. So simply, this particular factor 1 plus R whole to the power of N will always add, it will always add interest. It will always add interest to your present value. To get what? Future value. Are you getting? So immediately by multiplying 1 plus R whole to the power of N with present value, I'll get future value. That means what I'm doing actually here, I am doing addition of interest to the present value to get future value. So my point is, sir, why you are stressing this point? See, whenever you want to add interest, whenever you want to add interest to any principal or any investment, immediately multiply such investment value or principal value with what? 1 plus R whole to the power of N. That can be an interest rate or that can be a rate of return called profit. If you want to add profit or if you want to add some return to your investment, then immediately multiply such investment amount with what? 1 plus R whole to the power of N. So tell me one thing. If you want to add interest or if you want to add some rate of return or if you want to add some profit, then immediately multiply such present value with what? 1 plus R whole to the power of N. Please tell me, 1 plus R whole to the power of N, 1 plus R whole to the power of N is an addition factor or deduction factor? Addition factor. It is an addition. Addition of what? Interest. Remember this. Okay. Remember this forever. Remember this forever. Okay. That's why this is known as compounding factor This is known as compounding factor, an additive factor. It will add interest or it will add profit. See, it is not always been interest only. It can be profit also. It can be rate of return also. It can be an appreciation also. Okay. If your land is appreciating, today it is 1 crore. After 1 year, it is 1 crore 10 lakhs. There is an appreciation of 10%. Am I right? Today it is 1 lakh. After 1 year, it is 1 lakh 10,000. There is an appreciation of 10%. Today it is 1 lakh. After 1 year, it is 1 lakh 15,000. How much value has been increased? 15,000. Such 15,000 is 15% appreciation. Am I right or wrong? So this particular factor can add interest, or it can add some profit, or it can add some rate of return, or it can add some appreciation. If it is a land, or if it is a building, or if it is an asset, any asset, you can add what? Some rate of return to your present value of investment to get what? Future value. It need not always be money only. Because this is what application of compound interest or future value to your regular business obligations, to your regular business activities. Are you getting? Yes. So this is regarding future value, dear students. What is the formula? Future value is equal to present value into 1 plus r whole to the power of n. Yes. Where r is equal to interest rate per period. N is equal to number of periods. Here period can be an year, or it can be half year, or it can be quarter, or it can be month, or it can be a day. Is it clear? Period need not be year only. Period can be any period. Full year, half year, quarter, month, a day also. Is it clear? This particular formula is not applicable to years only. Here R need not be interest rate per annum only. Here R means interest rate per period. That means your interest rate can be expressed for 1 year, or it can be expressed for half year, or it can be expressed for quarter, or it can be expressed per month, or it can be expressed per month. That means per day. That means R is equal to interest rate per annum, interest rate per half year, interest rate per month, interest rate per quarter, interest rate per day. Right? The point is R and N must be expressed in same terms. Both of these terms, R and N, should be expressed for the same period. If I write R for 1 year, then N should be in years only. If I write R in half year, then N should be in half year terms only. I'll explain this later, okay? Just telling you, here R and N means need not be related to year. It can be related to any period. This is all about compound interest and future value. Copy this.